Hey guys, this is Market Update. Wednesday is the day for the approval of the ETFs according to the news that is being fed out into the market. I wouldn't call this rumors, I would call this preparation for the news event, right? So preparing the market for what is actually going to happen at this point. Let's go through how the market is positioned for this event, but also, where we go over the next 6 to 12 months, right? Is it a sell the news event, or is this the start of what is potentially a big rise to new all-time highs for BTC? The cycle would suggest that. So here we are right now. We're in a holding pattern, but we've had this on for months and months, probably about 6 months now or around that, this ETF announcement date. And well, we're here right now. So we are, essentially just consolidating into this. You've seen some fake outs, right? So we had a pump here that got rejected. We had a huge dump that got rejected and a big leverage flush. And we're actually just at the top of this range right here as of now, waiting for this announcement. So the announcement, I think, is positive generally, and you can see asset flows coming into crypto as well. But look, this is not a tradable event right now. It's done, it's over. So we have to look at the next 6 to 12 months. If you do trade though, check out Bybit, 30,000 deposit bonus down in the description. Just check the link down there for all of the details. Absolutely everything is done and complete for the ETFs. The media narrative over the last few weeks has been preparing the market for the acceptance. And so this is where we are. 19B4s have been amended and completed. You can see all that for all of these providers. These are the fees that they'll be charging, anywhere from 30, 39 basis points to maybe 90 basis points. The Grayscale ETF may be a little bit higher here, but there have been many rumors and articles in the press that even Grayscale will be converting from their trust, their GBTC trust. Remember, Grayscale actually won the case against the SEC, which then led us to this point. So BlackRock have been feeding information out into the press as well, potentially for a Wednesday acceptance or a Wednesday vote. That will be US time, of course, so watch out for that. Now, like I said, if it gets rejected or something else happens, obviously watch out below, because the media has been preparing everyone for an acceptance, and so that is the consensus at this point. What you can see here is funding rates across crypto. On the left, you can see all of the different crypto assets right here. Now, when things are yellow, that means that funding rates are extremely high, and that means that the market is positioned leveraged long, and so high funding rates. That means that everyone is extremely bullish, everyone is long, everyone is leveraged up, and of course, when everyone is bullish on one direction, using leverage, what happens? You get this huge leverage flush, right? So that happened here, and it's very clear to see very, very high leverage at this point. And then on the 3rd and 4th of Jan, you get this leverage flush. And that was the wick that we had down in the sell-off, the quick sell-off that we had down in Bitcoin a couple of days ago last week. That has not built up again. You can see that funding now is definitely more normal. This is good news. This shows us that the price that we have right now is there because of spot buying and selling. There's not too much leverage, and there's not too much one-way leverage in the system. So this is actually very healthy, in my opinion, very good. If we were leveraged long here, like if we were yellow, right, and everyone was leveraged long, then that's when you might start to think, well, you do have to have a flush at some point, or something has to happen, right? But that happened last week. That's actually very healthy, and it shook out a lot of the leverage traders and the short-term speculators. Now the market is much more normal, which may be quite positive for the price action in the short term anyway. Anyway, that's very, very healthy in my opinion. So we're in a good spot. You can also see here that this is short position. So this is CoinGlass again, just showing price levels where short positions may be. So around the 45,000 level, we've got some short positions here. Now these guys may get in or out by the time the announcement comes, and so probably not major. But I think the market is not overly leveraged one way or another, which is very healthy for the state of the market, potentially on this acceptance on Wednesday. Now, past the Wednesday announcement, they're starting to feed these articles into the press as well, which is about potential ETF for Ethereum. Now, the reason being is that Ethereum hasn't been called a security, along with most of the other top crypto assets. The CFTC have said very strongly that they believe Ethereum is a commodity, and they're prepared to challenge the SEC in court for that. And so ETH may be given a pass right here, and potentially we can start the rumor mill for the Ethereum ETF as well after the Bitcoin ETF. So I think generally pretty good news if you're spot holding. So comfortable in spot, holding Bitcoin, actually holding it, not leverage trading it. I think it's in a pretty comfortable position at this point. The ETFs are a great news story, a lot of banter about them, but let's look at the investment case here. The next 12 to 18 months, what is going to push prices higher? Because the ETF trade was been and gone, 20,000 to 40,000, good 100% trade there. What's going to push us to new all-time highs? It's central banks changing their tune. Are they going to do that? Here's the data that makes me think that they will. Weekly asset flows into crypto are positive. So this is good. We need this to continue to push prices higher. This is happening, but what is going to make it continue to happen? So the crypto course has been updated now. You can see these updates. If you have the course already, these are free, so just go and watch them. They're all here for you. If you don't have the course, I'll link it below. You can check out all of my latest updates as well. The price will be going up at the end of this week because of the update though. So what we can see here is that the Bank of Dallas president is saying that the rate of quantitative tightening has to slow down. Remember, quantitative tightening and high interest rates are designed to slow down the economy. That's all flipping on its head at this point as we get this data in to show us that the economy is slowing down. Now they're being slightly easier, right? They're saying, well, interest rates are done. They're going to start coming down soon. Quantitative tightening is going to start slowing down. There may be many arguments about how this will actually affect the markets, but the general gist that we need to understand is that it looks like the data is showing some weakness in the economy, and that means central banks can be a lot easier. When central banks are easier, risk asset prices can catch a bid. Now, of course, the potential downside here is that the reason they're doing this is because of a recession, and we don't know how that's going to play out. So that is a risk, and you're going to get volatility, of course, around that. But the end game here is that if that happens, they just reduce interest rates, stop QT, and potentially come in with more stimulus in some form in the future, which will push asset prices up further. That's what we're trading over the next 12 to 18 months. The average time between the last Fed hike and the first cut is around 6 months. Now, they stopped hiking rates in July, and so we are looking for them to cut interest rates fairly soon, potentially March or maybe around there, right? Again, the exact date is irrelevant if you're an investor. You're trading the next part of the cycle, which is interest rates getting cut, QT stopping, and if things get worse, potentially QE again or some version of that, right? So you can see interest rates are high. We're going to wait a couple of more months, and then we're going to start cutting again because that's what the data is showing us. Here is the data. ISM manufacturing right down at recession lows. You can see that right here. That was the 08 recession. We're now at a very similar point. At every previous time this has happened, you get cuts in interest rates and some sort of stimulus, or at least an easier rhetoric from the central banks. You see what happened here? We're very, very low again. This is why the macro is changing. This is why markets are trying to price in much easier policy from central banks. We're right down here now. They need to change their policy. Otherwise, they'll drive us way lower. So that's why they're starting to come out and say, well, maybe we should stop QT. Maybe we should cut interest rates, because the data is showing that. This is ISM services, weakness. Now, 52.7 is still growth. Anything over 50 is growth. But man, it's on the low side of things, right? Now, for a services economy like the States, this is obviously very important to keep above 50. However, you can see from up here, we're coming down in a downtrend. So this is why the central banks don't really need to do anything else, right? You can see that the economy is weakening, and so they don't need to be as restrictive anymore. We obviously don't want this to come down, because you can see each time this comes down below 50, you can't really see the gray here, but there's this one where my mouse is, and then this one here, recessions, this one, obviously the pandemic. If this comes down anywhere weaker, then obviously that is an actual recession with higher unemployment, because this is a services economy, right? Service industry. So we don't want a recession. We want the central banks to have a soft landing, but this is obviously not showing an extremely hot economy. This is employment as well. And as you can see here, ISM services, employment, inverted left scale, showing this survey, it's a very good indicator of rising unemployment. You can see that happening here. And again, this is spiked up. This shows a very weak employment scenario because it's, again, 43%, right? So very weak, and potentially a rise up in unemployment. Now, again, we don't know the extent. We don't know how this is going to work out. But for sure, if unemployment starts to tick up, the Fed is completely done at that point, because their two remits is price stability, which is basically happening now. Inflation isn't like it was before, and full employment. And if full employment is not happening, they will come and ease central bank policy to boost the economy, and therefore asset prices will jump up as dollar gets weaker, interest rates come down a little bit. Everything is showing us that we're coming through into that. And then, what we need is a central bank to push us up into the next inflection. The next inflection is what we want to be in the market for the next 12 to 18 months. That sweet spot of inflation's coming down because it's lagging, right? Maybe unemployment ticks up a little bit, but then the central bank comes in and eases things. And so that's what the market likes. We're not talking about the economy here. Unemployment is bad, obviously. We're talking about the market because you're invested in crypto, right? That's why you're watching this. And so that's what we want to look at, is how is the central bank going to react to this data? They've already stopped with the hawkishness, and they're starting to come down with their tone anyway and ease a little bit, which is good news for asset prices in general. I honestly don't know how the economy is going to escape a recession with all of this data. All of this data is showing us that the levels that we're at have preceded recessions in every other cycle. You can see them all here. All of these, red dots here, these are recessions, and we're at 20, right? So how can we not have a recession this time? Well, we're going to see it play out. If this data starts to get really bad, then of course you're going to get a scare in markets. You're going to get volatility to the downside because people are going to get scared about higher unemployment and everything. So there's a lot of volatility here, so to be wary of. But we know the end game, if that happens, is that interest rates will come down and they will stimulate the economy to the extent to make this obviously go through the next part of the cycle. So that's what we're playing for in risk assets. We're not trading the economy, we're trading central bank policy around this and asset prices that hopefully inflect to the upside as central banks get a lot easier. So probability of recession, you can see extremely high. We don't know whether they're going to soft land this or, we're going to get an actual recession. Doesn't matter, right? It doesn't matter because dollar cost average, strong assets when the central banks ease their policy. And that's pretty much all we can do at this point. So yeah, the ETFs are coming, great. But the next 12 to 18 months is the time to be in the markets for that potential switch in central banks policy. And that is the bull market for BTC, the halving, cutting interest rates, easier policy from central banks. That's what people are looking for. And that would be leading us into the typical cycle of Bitcoin climbing higher and higher over the next 12 to 18 months, because we're right at that point. So that's the way where we see it right now. How it's going to play out, obviously no one knows. If you're a trader, check out the Bybit deposit bonus down below. The Crypto Investor course has been updated as well. So if you have the course, check it out. I'm James of MoneyZG. Cheers for watching, and I'll see you in the next one.